Aloha everyone, Joshua Hayes at bigwavetrading.com. Just want to say what an impressive V-shaped move off the lows that was. I did not expect this. In fact, I expected a bounce off the 50 because we have discussed multiple times at bigwavetrading.com about how the SPY loves to find support off its 50-day simple moving average ever since November. It's been an automatic buy every time. Well, it happened again. But the move to new all-time highs, wow, impressive. Now listen, I put on some hedges to protect myself, and they failed. My long positions are still holding true. And during the past week, the only recommendations I have had are long positions, end-of-day swing trades and intraday day trades. No shorting, no nothing, but the hedges failed. However, I take my hedges long even on pullbacks to my good to cancel buy stop price. With stocks, I do not do that. They have to get, if it gaps up above my level, it has to trade back below the level and then trade up and through that level to trigger. If you traded my hedge ideas this weekend like that, you never got filled on any of them as the market never back and filled. But I wanted to say this V-shaped move, listen, it's good. There's no volume behind it. You don't fight it. The QQQ. If you want to chase up here, sure. You don't have much more room to the 3 ATR. You don't have a squeeze. So it's up to you to do something like that. It's not my personal recommendation. The QQQ is getting back up to that 3 ATR on the Keltner channel. No squeeze. DIA, plenty of run room. So this one's a little bit different. We do have a loose squeeze. But if you're going to get long a squeeze, you want to do it around the 21 EMA, not when it's extended. So it does have room to run. Now, the IWM, on the other hand, it's not playing along, and this bifurcation is still semi-problematic, but it's problematic because I'm a small cap, mid cap trader. So on the end of day swing side, big caps don't really show up that much based on the criteria that I use because it's just the way the market's been since 2013. Large caps have been the leaders. Mid caps and small caps have not. However, the quarterly portfolios that I run take care of that, and there is a way to trade big caps that are liquid using options, using stacked EMAs, squeezes, what have you. That does work. But from my end-of-day swing trade side, the bifurcation and the IWM compared to the rest of the market is preventing me from taking a whole lot of long signals. The ones that I do take are failing more than working, but we haven't had that many. But here's the thing. I'm not putting a lot of size into them. We've all discussed, I'm only max risking 1 R per trade until the small caps start taking leadership again. Until the small caps and mid caps do that, I'm careful on the end of day side, focuses on the big caps and intraday time frame. Now the IWM, another thing I'm noticing about this market, while the SPY, DIA, and QQQ have hit new all-time highs and the IWM hasn't, when we pulled back at the end of last week, we did it it was a universal pullback. Uniformity amongst all the 4 majors. As we bounced, everything was kind of looking lockstep at first, but the last 2 days, the IWM has not kept up with the SPY or QQQ. So the rally continues to thin out. I don't fight price. And heck, I expect higher prices now that we built out to all-time highs. Well, where are we going to go if we break out to all-time highs? I'll just use the SPY just to give you guys an example how you can do this. You can use Fibonacci retracement level and work it backwards. You take the highest high before the pullback to the lowest low of the pullback. You will see here we have a 127 and a 162 projection. This is where, this is the ultimate zone. Let's ignore that for right now. I would expect SPY should be able to make it up to here or up to here, which would then eventually line up with the 3 ATR before we pull back again. I could be 100% wrong. That's always possible. You could also take a Fibonacci projection, and I don't use it on this. I use it on TOS, but I believe this is how you use it here. We'll connect it to that high and then to that low. So from this low, this swing low, to this swing high, to this swing low, it kind of lines up around that same level. So this is a little bit above 445.75. So we can expect the market to possibly move to 442, 445.75, 447, with an ultimate target up here around 460. And of course, now that we're at all-time highs, we can start using round numbers, like 440, 445, 450, 455, 460 as other guideline and projections. But strong market, wanted to show you guys that. But at the same time, you guys got to take, when you're experienced and you've been doing this for a long time, you know the seasons when to be aggressive and the season to be careful. And we're heading into two of the most bearish months for stock market returns since 1950 in the S&P 500, which is August and September. On top of that, we have another V-shaped breakout to new highs. Every V-shaped breakout ends the same way, but like you just saw with the projections, it could go much higher before it eventually reverses. However, eventually, guys, now that breadth and volume is waning, the breadth and volume is waning, eventually one of these pullbacks is going to lead to a steeper pullback. If you think that the SPY is going to find support at the 50-day simple moving average every time it pulls back there, that's not logical or rational. It's not going to happen. Eventually, one time it's going to test this 50, fail to bounce, break below the 50, and we're going to see this thing come back to the 100 or 200 simple moving average. It's going to happen. Hasn't happened yet, but it is a possibility. And I just want to show you that weakness in case you guys didn't see the last video. No particular order, and we're just going to go through the line. And then actually, I'm going to ask for assistance if anybody can help me. There's a certain kind of chart that I'm looking for that I can't quite figure out how to make up, and I haven't been told how to make it yet or reached out to their support because it doesn't look like they have technical indicator support at stockcharts.com, but I could be wrong. But I just want to show you breadth. If we look at the advanced decline line of the Dow Jones Industrial Average, okay, that's good. I'm very happy with that. We have new highs before the DIA. We have new highs confirming with the DIA. Thumbs up on a closing basis. This is the mid cap. Okay, this lines up with the mid cap index. Notice off the September lows how we've been trending higher, kind of flattening out and rolling over. No, this is one of the reasons it's helping confirm the weakness in the IWM. This is the Nasdaq advanced decline line. Okay, we know the Nasdaq's at new highs, right? Remember that strong advanced decline line. Breadth is waning, and that's what I want to point out. The Nasdaq 100, though, new highs, advanced decline line. That's confirmation of the narrowness of this market. Dow Jones Industrial Average, 30 stocks. Nasdaq 100, 100 stocks. Here's the New York Stock Exchange advanced decline line. Is that confirming the SPY? No. How about the NYC common stocks only? Nope. How about the S&P 100? Yeah, once again, the most narrow S&P index. How about the small caps? Nope. How about the S&P 500 advanced decline line? It's close. But once again, we have that negative divergence. It's not confirming the new highs in the SPY. Nothing to get worried about yet, but problematic. Still, something that I'm concerned about. It's not going to stop me from getting long stocks, but when that eventual pullback comes that is more harsh, I won't be shocked. This is the advanced decline volume line. It's negative divergence to the Dow, right? Let's go to the next page. S&P mid-cap advanced decline line, confirming the weakness in the IWM. No positive divergence there. Here's the Nasdaq advanced decline volume line. This is good. This is good. I got to admit, I like this, okay? So now I know Nasdaq 100, Dow Jones Industrial Average, and Nasdaq stocks, okay? Nasdaq 100 advanced decline line. Close enough. Close enough to new highs right there. Good enough. Very, very much so. NYSE, not confirming the SPX. NYSE common stocks, advanced decline line's pretty lame. Even the S&P 100, not confirming the index. And then, of course, the small cap advanced decline volume line. Of course, we know that that is weak. This is the S&P 500 advanced decline line, volume line. No confirmation there. So that's just what I wanted to show you with the internal indicators. Now, I need help. I'm trying to add another indicator to this. If anybody knows how to help me, I'd appreciate this. And I'll show you. Difficult to read, but what you see here is I'm looking for these on all the indexes: SPX, NDX, the Dow, and the small SML and MID. I'm looking for them all, right? But it's exclamation mark U volume up volume Nasdaq 100 minus exclamation mark, down volume, Nasdaq 100. I type these in to my stockcharts.com window, and I do not get this line. That's very similar to my advanced decline and my advanced decline volume lines. I notice that this says cumulative on it. So I tried to add the CUM in front of the U and the D on all these, and it didn't come up. So here's my question, guys, if you can help me out, if anybody can help me out before I reach out to stockcharts.com in the notes section. How do I get the cumulative line? If I put this into stockcharts.com, this is what I get. So if you look at this, you'll see I've typed in the same thing as you see right here, have the same setup, but do you see the word cumulative? I'm missing that. That's not on this chart. So that's what I need assistance with. If anybody knows, please help me out. Thank you very much. Outlook for coming into this trading week, I'm still going to be looking to day trade stocks like XBIO, NURO, NRXP. Intraday is my time frame. IPA. These are going to be my focused. This is where I'm focused right now. This kind of time frame, short term, intraday, hot momentum names. I know what I want. I know what I'm looking for. But on an end-of-day swing basis, it's still a little rough. However, I put some hedges on. I just want to show everybody how you could have even avoided taking a loss in this. So with TECS, I recommended this one last weekend as a hedge. And great, it worked out the very next day. Too bad it gapped up. If we would have got a gap down and a trade up through 486, we could have probably taken some profits off of the table, but still would have been holding it. However, it gapped up, and on that day, the low day is 496. My limit was at 4.8. My stop was at 486, and I added 5 cents for a limit offset, so 491 hit 496. So no trigger, no fill. Now on hedges, I keep that order on the book to fill on a pullback. So since it gapped up, I readjusted my stop and limit. My stop stayed the same at 46, but I adjusted my limit to 486. When it pulled back the next day, it triggered and filled. However, if this was a stock, when it pulls back and closes below 486, so when it gaps up like this and doesn't fill, the trade is paused. I pause it at Interactive Brokers. The next day, it closes at 480, which is below 486. I call that trade back on. I unpause it. Now, if it triggers up and through 486, it's a new long. Well, the next day, look at what the high day was, 483. So it didn't trigger up and through 486. And then failed. Had to take the loss on TECS. But if you use my methodology and only get long via strength the way I do with stocks, not hedges. Hedges I let fill in the pullback to balance out my long positions in case this market sell-off would have gotten worse. You wouldn't have a position. Now, when I got filled this day. So immediately, I put a stop here. I had a third of my stops here, a third here, and a final third right there. The next day, that gets taken out. Now, whatever I have left, a third went here, a third is here, a third is here. That gets taken out. Now, I have half here, and the final half right there at 450. That gets taken out on Friday. I'm out with less than a 1 hour loss, and that's how I protect myself to make sure that in this market environment, if something doesn't work out immediately, I'm not taking that full 1 hour loss. TECS was not a full 1 hour loss. In total, it was about a 0.5 hour loss. However, if you only got long via strength, you never got a position in TECS. And that's how I do long positions. I just don't do hedges that way. So I'm just going to end the video lesson off by saying that I only have one new end-of-day long signal of quality this weekend for Monday, because there's only one. That is for premium members of the gold and platinum level only. But also, the most important thing to bring up is that big caps are in favor right now. This new long position that I have is a mid cap, has a 4 billion market cap. Right now, this market is favoring 10 billion plus market caps. That's where I would focus. All right, we're going to wrap the video lesson up there. Thank you for watching, everybody. I love you all, and I'll see you next weekend. Aloha.